Well, it's been a while since I've done an applied series, and I thought with all the discussion of the rising national debt in the U.S. and across many developed countries, we'll use the U.S. as a good example of the level of rising level of debt and what it means. And as I go through it, I'm going to point out several things. It's easy to look at a top line number and say, oh, that's unsustainable. But you have to break apart that top line number and see exactly what's going on. And you have to look at debt relative to other things. That after we go through a few screens, we'll come to the conclusion that the debt in the U.S. is just not a problem. In fact, it's an opportunity. If you're an investor, you should be calling for even more debt. And I'll explain that when we get to that screen. And then I will end with what I think is a decent end-of-year target on the S&P 500. So let's just start with debt, the level of debt and the level of GDP. This green line here is the growth in GDP since the beginning of roughly, it looks like 2000. And the red line is the growth in debt over that period of time. And you can see there are periods of time where it does this, where it just goes sideways. Here, it went sideways here and sideways here. What's going on here? Why is it going sideways? Those are all of the debates about the debt ceiling and raising the debt ceiling and shutting down the government and who's shutting down the government. So it tends to go sideways, and then after they have an agreement, you see this jump. But it really should have been like this if you avoided all of those talks about shutting down the government and the debt ceiling. You wouldn't have had these sideways movements. It would have been a much, here again you could see, you could just fill that in and be a much smoother trend. So when we look at debt, we would say, well, debt's way up here, GDP is over here, we're over 100% in terms of debt to GDP. That's not a good thing. But you have to look at who holds the debt. So let's start up here with total debt, 28.2 trillion. 5.9 trillion of that debt is held by federal trust funds and other government accounts. So that's the government owing money to itself. So when it pays interest on that debt, it's paying interest to itself. That if it wasn't paying interest to itself, it would have to come up with the money to pay that anyways. So we don't really count that. So let's take that off. You get to 22.9 trillion. And that is the number that tends to be compared with the total amount of GDP. So you look at 22.9 trillion versus 22.1 nominal GDP. You're sitting just a little over 100% of debt to GDP if you ignore what the left pocket owes the right pocket in terms of what government programs hold. I'll explain the government accounts and the trust funds in a second, and I'll give you a great source that if you want to really get your head around the interest expense that the government pays, this is a great source. Let's not forget, 5.4 trillion is held by the Fed. Now, the government still pays interest on this, but at the end of the year, the Fed transfers it back to the Treasury, meaning that all the Fed is doing is providing digital zeros, ones and zeros in a bank account for the government to spend. Government's giving it interest, and then the interest goes right back to the Treasury at the end of the year. That's not really debt. That's just sort of help in financing thing. That's 5.4 trillion held by the Fed. You got 17.5 trillion held by private individuals or private investors, things that are not trust funds, federal trust funds, government accounts, or the Fed. And 40% of that is held by foreigners. So 60% of that debt is held domestically. So if we think of private debt at 17.5 and GDP at 22.1, you're 79% of debt to GDP. Not the little over 100% because we're counting the Fed, and certainly not the 130, 140% number, top line number, because you're really not going to count money that you owe yourself. I mean, sure, you have an asset. I have a bond, but I also have a debt because I'm the one who issued the bond. Well, those cancel out. If you're just moving money from your left pocket to your right pocket, you're not getting any richer, you're not getting any poorer. So that's why we cancel those out. Let's see how close I got on the 17.5 trillion here. Let's look at what the St. Louis Fed says the amount of private debt in or amount of public debt in private hands is at the end of Q1 2021. So here is a chart from the Federal Reserve Economic Database. You can find this at this website down here. This is federal debt held by private investors, 17037.1. If you click on the plus more, you'll get it by quarter leading up to this quarter. This was updated June 2nd, 2021. So this is the most current data that I could find on this 17037. I got to 17.5 just by doing some very quick math, but my numbers may not have aligned with the end of Q1 2021. It's hard to find sources that all have the same ending date. Let's go back to that previous chart. I just want to show you something on the growth rates of GDP, and then we'll move forward. Okay, so our green line is GDP. Let's just look at the growth rate in GDP that we had, and I'm going to just draw lines, and we're just going to look at the slope. We're not actually going to calculate any growth rates here. But this is leading up to the financial crisis. You can probably fit a nice straight line across it with a slope that looks like that. And after the financial recession here, you could find a nice, very nice straight line here. But notice that this slope, if we just move this over here, this slope is lower than the previous growth rate. So the growth rate coming out of the financial crisis 2008, 2009 was slightly lower than the growth rate that went in. But look what happens here is the green line diverges. So let's draw a growth rate line on that. And this looks to be about that slope right there. Which, if we bring this line back here, notice that it would be a higher growth rate than what we had before the financial crisis. So something happened in this period of time over here which caused GDP growth to do this and then to go a little bit higher. In fact, a higher rate of growth than what we had previously. These are the tax cuts. So tax cuts do have an effect on GDP growth. And when we think about taxation or revenue, you can have a low level, like what we had over here, a lower growth level in GDP with higher tax rates, or you can have a higher growth rate in GDP with lower tax rates. So if lower tax rates push GDP higher, you're not sacrificing government revenue for this. But during this period of time from 2000, roughly about 2009, and this was, the person whose name I'm not going to mention's tax cuts right about to this time. This was Obama's term, and we can see what happened to debt over that period of time with a slower GDP growth rate. And we have a higher tax rate here, but we also have debt increasing pretty much at the same rate. So I don't know that there's too much benefit in that. However, when we control for who owns the debt, it's really not that bad. I just want to point this out about the tax rate because I'm going to come back to it after. That lower tax rates will result in higher levels of GDP growth, and you can always get your debt to be more manageable if your debt, even if your absolute value of debt is increasing, if your debt as a percentage of GDP is lowering over time. GDP times your tax rate is your revenue generator to support the debt. So if you have a higher GDP growth rate multiplied by a tax rate, you have a higher ability to service that debt. As a percentage of GDP, it begins to fall, even though the absolute amount begins to grow. I have a whole screen later on when we get to conclusions that will talk about that. So here we have net interest outlays, debt, and interest rates from 1970 to 2020. And net interest outlays is how much the government puts out in net interest. And we say net interest because it has a certain amount of debt. We saw it was 28.2, and it pays interest on that. But it's paying interest to itself in many places, and in some places, because of what it's funding, especially government credit accounts. It'll fund government credit accounts. Those actually generate interest income. So it does bring in money, which is a great form of investment. If you're using debt, you invest in something that then returns more than the cost of debt. Any corporation would do that all day long. So there are some wise things being done. This is net, that after you count everything that comes in and everything that goes out, what went out, and it's a percentage of GDP. So you can think what I said on the previous screen. You have your level of GDP times, we'll put T star, meaning the average effective tax rate in the economy. And GDP times T star will equal your tax revenue that a government will bring in. And you can look at debt times, and I'll put I star, meaning the average effective interest rate in the economy, and that will be your interest expense. So we can do, you can think of a lot of things. The higher you push GDP, the higher your tax revenue is that supports your debt. You can also say, well, the higher the tax rate, the higher the tax revenue. But there is a relationship between these. The higher the tax rate, the more you slow down GDP. So, there is some optimal level of taxation. I don't know what it is. I don't know that anybody knows what it is, but we continue to play with that number. But over here, if you look at interest, the lower the interest cost, the lower the interest expense. So this looks at net interest outlays versus interest rates on selected treasury securities, the 10-year note and 3-month bills. Look back between 85 and roughly about 97. Net interest outlays were well over 3% of GDP. And we still have, over that period of time, increased GDP significantly. And this probably was a bigger problem than it is today. So that if you draw a line here at the top level here, you're somewhere around 1.6, 1.7. You're half. In other words, the cost of servicing the interest on the debt is half the burden in relation to GDP than it was in the 83 to 97 period, even though the debt is significantly higher because of this. Remember, you can play around with the interest rate, right? Well, look what's happened over that period of time. Rates have come down. In fact, from 2000 to 2000, roughly, this was the financial crisis here. If you go across here, you had 5% rates on 10-year notes. Here we are over here. This is the 2% line. Everything is less than 2%. When you look at financing any big ticket item, people don't really look at the sticker price. They look at the monthly payments. So that if interest rates are lower and lower and lower, you can afford a higher and higher and higher purchase amount because your monthly payments would be the same. And you can think about the same thing with debt, is that you can afford a higher level of debt if your interest rates stay low. And right now they are low. And we'll look at a forecast, I think a very rigorous forecast for interest rates. And then we'll think about, sort of how the Fed is looking at interest rates and what are critical success factors when you have this level of debt. But to put it into, just to sum up this screen, to put it into context, this is less of a problem than this, and this was not a problem. So this clearly is not a problem because we have rates that are below 2% as opposed to 5%. And even when they were 5%, it wasn't that high. However, when they were 5%, it was the same level as it is now, but debt has done this. So even though debt has done this, this should have gone back up. The lower rates push that down. So let's see how long we're going to stay low for. Okay, before we look at our forecast, we'll look at a forecast from 2021 all the way out to, I think it goes out to 2030 or 2040. In terms of the net interest as a percentage of GDP. And this is from 2010 to 2020, 1.3, 1.5. Notice how low it is here. It only really became, jumped up here, 1.6, 1.8, 1.6, but it's still well below 2%. Comparing that again, going back to that 83 to 97 period when it was 3.2, 3.3%. Even with the level of debt that we have, 1.6%. And it talks about, it sort of lays out gross interest on Treasury securities across the years, interest received by trust funds. It talks about what trust funds: Social Security, civil retirement, civil service retirement, military retirement, Medicare, unemployment insurance, other interest and investment income. And B, other interest, is primarily interest on the financing accounts for federal credit programs. So the government will, or the Treasury will, seed a credit program with a bunch of money, and that money comes from issuing Treasury securities, issuing debt in the public, using that money and issuing these credit programs like student loans. And then they make a bunch of loans, but then interest is paid back on those loans. So it actually is an income generator. So they're just investing in a program that then helps some other social program that does have some interest income component to it. So it does actually generate negative interest cost, which is an interest income. So there's your net interest amount along the bottom, and as a percentage of GDP. Let me show you the document that I used for this. I'll leave this link in the description box below. This is from the Congressional Budget Office, and it talks about the federal net interest. And it is very accessible in terms of its readability. It's not written by academics for academics. It's written by very good practitioners for just the general public, so that you can read it and actually understand it. There are some technical terms and some of the charts and some of the exhibits you may not understand unless you do have some finance and economic background. Let's begin. Chapter 1, net interest in the federal budget. It explains what that is. These little boxes here, really good and interesting to read. So it talks about negative interest rates. And asks, can rates on Treasury securities be negative? And it gives you some really good information, some good insight into how they're thinking. We've already seen this one. This is net interest outlays. We've seen it drop even though debt has increased. It's because we have this beautiful thing going on down here, which helps support this level of debt, which is lower interest rates. I've shown you this chart, net interest outlays. Then the next few charts break it out. So if you were interested in other interest and exactly where it comes from, see the negative 30, negative 36, negative 9. This is what we saw up here, right? Negative 30, negative 36, negative 9. So it explains this other interest be primarily from financing accounts for federal credit programs. It explains which programs that it has. And then if you're still not sure on that, it actually explains what one of these financing accounts are. With a nice little graphic here. So it teaches you, and it's not just a report. It's actually very interesting to read. There are some forecasts in here, so let's continue on down and see if we can get to the forecasts. Net interest in this is chapter 2 in the CBO's projections. So we're over here now, 2021. Look at this, as a percentage of GDP. We're expected to drop actually and get more affordable into 2025, 2026 before it really starts to turn up at the end of the decade. Debt held by public expected to be sort of flat all the way to 2027, then increase. And here is their forecast for interest rates with the 10-year increasing. And it looks like, wow, it's really going up, but have a look at the percent on the side. If we draw across from 2%, we get all the way to about here. That's 2025. We're sitting just below 1.5% on the 10-year Treasury now. So over the next 4 years, they're forecasting a 50 basis point increase in the 10-year note and almost no movement in the 3-month bill. Only in 2027 does that really start to increase. So they're projecting 4 or 5 years of relatively very low rates, very accommodative rates. Well, that means something for us as investors. As investors, I don't want you to think about the debt. I want you to think about debt as a beautiful thing and let's keep it going. As investors, as citizens, well, that's something else. And we'll leave that discussion for the sociologists. Here are baseline projections of net interest outlays from 2020 to 2030. And this is the important line right here, net interest as a percentage of GDP, because GDP will grow. You can say, listen, every household has a debt burden. And you might say, you know what, our mortgage payments are going to be going up. Our property taxes are going to be going up. and the interest rate on our credit cards and on our car loans are going to be going up. Yeah, but our income is also going to be going up as well. So that the affordability of all of that may actually improve if your income is rising faster than your debt service costs are. So look what we have here from 2020, 2021, 1.4, 1.3, 1.2. Look at these golden years, 2023, 24, 25, 1.2. 2026, 1.3, and then it starts to increase again, 1.6. That's where we are now. And look what's going on, right? We're at 1.6. The economy is robust right now. Pent-up demand. There's a supply shortage, but anything that's available is being bought up. So I think that can continue for 3-4 more quarters. And then I think that we have a good 4, 5, 6 year bull market ahead of us. This here is sort of in line with that, suggesting that, GDP will grow such that the net interest as a percentage of GDP will actually shrink over time. 2029, 2030, it starts to peak up over 2%. But remember, from 83 to 97, it was over 3%, 3.2%. And if you remember the 80s, from 84, 85 onwards, it was prosperity, huge bull market. You had a recession in the late 80s. You had a housing bubble that crashed in the late 80s, early 90s. But then you had the major run-up throughout the 90s, ending in the dot-com boom. So, and that was at 3.2%. This is only 2.2. So that's not so bad. It does get a little bit more interesting. Let's have a look at that's other interest. There's a sensitivity analysis down here. Alternative scenarios for net interest outlays. The effect of higher rates, what it would do to higher rates. This is the net interest outlays in their projections, September 2020. There's their baseline. Here's what it would add. If rates moved up sooner, it would tend to add things. It starts to get troublesome around 2025, 2026. When you look at 288, you're going to add another 71, 25% more. 317, you're going to add another 94. 367, yet another 121. This is where some problems lie with higher interest rates. Effect of flat interest rates, meaning that rates aren't going to go up. They're going to remain flat. They'll probably stay at this level for a very long period of time. And based on the last 20 years of yields, I don't see why we would think that we would return to 5, 6, 7% interest rates. Rates, if you look at Japan, for example, rates have been at zero for how many years now? Going on 20 years? That I think that the natural progression for rates is towards zero. There is no returning. I don't think there is any returning to the 5 or 6% level unless you believe that inflation is really going to be the thing. 70s style inflation is coming back. I don't think so. I think that this is probably more likely. Now look what happens. You're subtracting. It becomes even more affordable over time, because these lower rates will actually be beneficial to GDP. GDP can grow at a higher rate, which means that you'll have a higher tax revenue, which closes any deficits or minimizes deficits. And your financing cost for your debt as you roll it over actually comes in lower. Look at these numbers. Those are nice, right? And then there's the annual increase in borrowing of $100 billion. So if you add this up over the next 10 years, they're saying, well, what if they borrow another trillion more than what they say they're going to do? This is the effect that would have the additional borrowing that would have, and then as a percentage of GDP. How that would affect that. So I think this is a fairly interesting table to read. And they have net interest outlays under various interest rate scenarios. This was their baseline. Interest rates that remain constant at the end of 2020 levels. Look at this. Isn't that nice? Net interest outlays just start to drop. And I believe there was a really nice exhibit in here. This one here. This is box 2-1. If you are a level 3 candidate, when we look at these factors over here, growth of the labor force, domestic private saving, foreign savings, these are considered sort of risk factors to their projections. You should understand all of these. Some of these we saw at level 2: economics, growth of the labor force, total factor productivity growth, the capital share of income. But if you're at level 1, some of it may seem confusing. Level 2, you should pretty much get most of this. Level 3, you really should understand everything in this particular box, and you should find this table extremely interesting, because when we look at fixed income at level 3, there's a whole reading on yield curve strategies, which really deals with what is your forecast for rates going forward. What is your forecast for where the spot curve will be, where the forward curve will be? Do you believe the forward curve? Do you believe it is unbiased? Do you think that rates are going to remain flat and stable for a period of time? And if you do, well, there are certain bond strategies you would follow for a flat yield curve, right? So this is all rather interesting stuff. The link is in the description box below. I do encourage you to read this document. It is not difficult to read. Some things you might not understand, but that's okay. Just move past it. But when you're done reading this, you'll have a much better understanding of the net interest expense on debt, which is the thing that we want to keep our eye on. Okay, let's just bring in a little analogy here. When we're talking about debt, I'm going to introduce a company, and we're going to increase the company's debt and increase the company's financing cost on that debt. And we'll see whether or not we have a problem. So let's take company A, and it starts its life out with $5 million of debt at 5%. 10 years later, we note on its balance sheet it now has $50 million of debt, and it's now paying 5.5%. The number here is the annual cost to service that debt. 10 years later, we come back and it's got $500 million in debt, and we say, look, we started with $5 million 20 years ago. Now we're at $500 million. This is an unsustainable trajectory. And look at your interest cost, 6.25%. It's now costing you $31.25 million a year just to service that debt. This can't continue on. And if you look at just the level of debt, yeah, you can fall into that trap of saying this is unsustainable. But you have to look at debt relative to your ability to afford it. So let's look at equity over that period of time. At time 0, we have $5 million in equity, $5 million in debt. Our debt equity ratio is 1 or 100%. In other words, our debt is 100% of our equity. And we have $10 million in assets, because if we have $5 million in equity and we have $5 million in debt, assets equal liabilities plus equity, we must have $10 million in assets. To be able to afford this level of debt, our assets have to produce a 2.5% return on assets. And that's where we started. 10 years later, we have $100 million in equity, $50 million in debt, so debt equity ratio is 0.5. In other words, debt represents 50%, is at a level that is 50% of what our equity is at. We now have $150 million in assets, because we have $100 million in debt, $100 million equity, $50 million debt. Our assets now only have to produce 1.83% return on assets to afford the debt service cost. In year 20, we have $1.5 billion in assets. So now our debt equity ratio is 0.33 or 33%. And we have $2 billion in assets, the $1.5 billion, the $500 million. Our assets now only have to produce 1.56% return on assets. Look what's happened over time. If you just looked at debt, you would have said $5 million to 50 to 500 million. You can't continue on like this. It's way too much debt. But when you look at it in terms of debt as a percentage of our equity, went from 100% to 50% to 33%, it's dropping. You'd say, well, that's pretty good. How hard our assets had to work just to service the debt, 2.5% to 1.83 to 1.56. If I gave you those numbers, you would say, well, debt is not really a problem. Debt's becoming less and less and less of a problem, which is why you cannot just look at the level of debt. You have to look at the affordability of that debt. So as long as your assets or your equity is rising, and in the US when we go to a macro level, we don't really have equity. We think of GDP, because GDP is the revenue generator for the government, because you multiply GDP by some average tax rate that represents the revenue that the government can generate. So you have to look at it in the context of GDP to put it into perspective, and then you have to look at the affordability of it. When we take GDP and we multiply it by that particular tax rate that equals tax revenue, what percentage of this tax revenue is used to finance the debt? And we saw on the Congressional Budget Office's forecast, we're at 1.6% right now. By 2025, we're expected to get to 1.2%. That becomes more affordable as time goes on. So when we think about debt in a relative sense and how hard we have to work to afford that debt, we have to work less. Our assets have to work less to afford the debt, and debt is becoming more and more affordable. And at this point, you can almost argue, listen, you are under leveraged at this point at 33%, that if you wanted to have a more effective debt equity ratio, maybe it should be 40%. Who knows? I don't know. But at 33%, you may even argue that the firm is under levered. Is the U.S. under levered at this point? Okay, let's put some conclusions. I'll end this screen with, I guess, kind of a controversial statement, but we have to stop thinking like citizens and start thinking like investors. And I'll use an analogy of a restaurant to explain that. The level of debt is not the issue. Stop looking at the national debt. Stop looking at that level. Once you back out what the government owes itself and what the Fed is sitting on and look at private debt, if you want to look at a level of debt, look at private debt. That still is only a small piece of the picture. The level of interest rates are what we want to pay attention to. This becomes more and more important because if we can keep rates lower for longer, we can sustain much higher levels of debt. Not only much higher levels of debt, let's say that we don't go any higher, the level of debt we have right now is not a threat, not for a very well-developed economy like the U.S. So if we're looking at the level of interest rates, there's really only two things we care about: the Fed and inflation. And the Fed has been very clear about what it wants to do. It's been as transparent, I think, as it can be. It's not even talking about raising rates till 2023. And to use an expression that's been used a lot, they're not even talking about raising rates. And that means in 2023 they'll start talking about raising rates. So we got to look at inflation. And the big questions right now come from two sides. Is inflation transitory? Or is it the direct result of money supply growth? Now, if we think that it's transitory, well, then inflation will have this bump in prices, and then inflation will go back to 1.2, 1.3%, maybe even sub 1% inflation. If we think it's the direct result of money supply growth, then that is a problem. So right now, inflation is probably the biggest ticket game on the street. Whenever inflation is reported, that has the potential to move markets. In many periods, I think from 2010 to 2019, inflation was, okay, report the number, but it's not a big thing. It's not a thing, and I during that period of time, believed that inflation will never be a problem again, only because the economy's potential, especially with automation, the economy's potential is so much greater than what actual GDP could be. You'd never get to these supply constraints. Oh, maybe in this sector and that sector for this raw material or that raw material, but not a broad-based supply constraint problem. Well, we do have inflation. We are seeing inflation, and this is the big debate now. Which one is it? If it's transitory, it's not a big deal. It's not a big deal at all. There's nothing there. The inflation we have right now, is it just too much money chasing too few goods, or is it just too few goods available? Just a bunch of supply issues. And it's a little bit of both. You had a pandemic for a long period of time. People really couldn't go anywhere. So we saw in a lot of countries the savings rate jump. For investors, that means this over here is opportunity. This is not a threat. This is an opportunity because you have this huge amount of pent-up demand. One thing that you can count on in developed economies is consumerism. It is a religion. People want stuff. They want stuff. They're going to buy stuff. They can't wait to get out there and buy stuff, any stuff, as long as they have stuff, because stuff equals happiness. Let's not talk them out of that. If they believe stuff equals happiness, great. Go buy your stuff. I'll own the companies of the stuff you're buying. Thank you very much. There are two types of inflation, right? Demand push, cost pull. Demand push is just too much money chasing too few goods. Well, right now you do have elements of that. You could say, yeah, there is too much money chasing too few goods. But the too few goods is not a natural economic position that we're in. It is because a lot of supply chains have pretty much shut down. Hey, I got a pool in my backyard, but I got no liner. Nobody can get a liner. There's a couple of new pools that have been installed in my neighborhood, and they're all empty because no one can get a liner. There's a shortage on liners. So here's your pool. Got lots of that, but we got no liners. So here's your hole. So I got a nice big hole in my backyard. That's it. When am I going to get a liner? I don't know. They don't know. They don't know. What price is it going to be? It'll be the price we say it's going to be, and if you don't want that price, then you're not going to get one. Well, that's inflation, right? Because there are no choices anymore. You take what you can get. It's supply issues. I don't think that anybody can really make the argument that, no, there are just way too many consumers buying stuff. Well, if there's nothing available, you can't get it. It is supply issues. We're seeing supply bottlenecks all around the world in a whole bunch of different supply channels. And because it's supply issues, I'm willing to bet more and more that it's transitory and not the direct result of money supply growth. So what do we do with this? Let's look at, being that we know what we're looking for now, this is the big thing that we're looking for. This is less of a concern. I don't think the Fed is really concerned, but the Fed is watching this. Everybody's watching this. This should be the only thing we're concerning ourselves with right now. And when you do get the inflation report, we're diving into the numbers to see, well, where is inflation coming from? And trying to figure out if it's going to be transitory or not. The one place where inflation would actually be very, very good for GDP growth is wage inflation. So if there was a significant jump in wages because of labor shortages, and right now lots of companies are reporting labor shortages, we're having the same problem. We need a few people for particular tasks. Good luck finding them. People are being paid to stay at home. And that's it. So now you're competing with that. So, if they're being paid $20,000 a year to stay home and you're offering them $40,000 a year, in their mind, they're thinking, but you're just paying me $20,000 a year. I'm not going to work for $20,000 a year. I want $30,000 a year, but I'm being paid $20 to stay at home, so you got to give me $50. And while all of that pay to stay at home is going to end soon. But companies everywhere are reporting that they just can't find people. People just don't show up. Because, if you pay people to stay home, surprise, surprise, they'll stay home. Not everyone, but enough people will stay home such that you have supply shortages. So wage inflation would be a good thing because you're putting money into the hands of people who are going to go buy stuff. Stuff. They got to have more stuff. Beautiful. Give them more money if they're going to go buy more stuff. I'll own the companies of the stuff they're going to buy. So wage inflation isn't a very bad thing. It might even, it would be good, I think. Prices would adjust eventually if there's wage inflation such that you fall into that trap that economists call money illusion, where you say, I'm making more money, I'm richer now, I'm wealthier now, without realizing that you've made more nominal dollars, but in real dollars you haven't because prices have risen. The other nice thing about inflation is, remember now, we take GDP and we multiply it by this particular tax rate, which is the average tax rate across the economy, such that we get the tax revenue for the government. Well, this is nominal GDP, not real GDP. So inflation goes up 5%, GDP can go up 5% just by prices going up. Well, tax revenue goes up. And that's the nice thing about inflation is you can increase tax revenue without increasing tax rates by giving people the illusion that they have more money, but they don't. Over the years, wages have gone up. over the years. The average wage has gone up, but so has the average price level. However, the affordability of life has actually decreased, such that you're going to find it harder to make ends meet in 2020 than you did in 2000, even though you make more money. You're just going to find it harder to make ends meet on the same amount of money. That's called money illusion. I just have to give you more money, you'll feel better. But this money is taxed. Nominal rates are taxed, which means you actually have to do better than inflation over a long period of time just to stand still. So anyways, let's look at mistakes that could be made. Raising interest rates too soon is probably the biggest mistake. So we're going to keep our eye on inflation, and we're going to hope for lower rates longer. The lower rates stay for longer, the better the economy will be, the better the market will be. And that's all we care about as investors is are you going to give me a bull market that continues? And the best way to get to that bull market is to keep rates low for as long as possible, and to open the economy, to accelerate that if we can, such that we can deal with all these supply issues and get rid of this inflation. If we get rid of inflation, the Fed has no purpose to raise rates, especially with unemployment at 5.9%. It's not going to budge till it's like at 3.5%. Another mistake would be new taxes or higher taxes. And when I say higher taxes, I mean the type that Sanders and Warren advocate, the Sanders-Warren style taxes. That would be a mistake, because that will slow down GDP growth very, very quickly. When I hear politicians talking about the successful people, I'm not going to call them rich. Rich is an outcome. Successful is the input. Work and sacrifice is the input. And that's called success when you reach your goals. When I hear him talking about successful people need to pay their fair share, if he means that, listen, their tax rate is 40%, they should pay 40%, I agree. If they're not paying the tax rate that they're supposed to pay, absolutely I agree. But if you mean, when you say fair share, that your fair share should be 70% of your income and not 40%, then I disagree. California is a good example of raising tax rates, but giving no further benefit for it. In fact, having a worse environment even with higher tax rates. What's going on? Money's leaving California because it can. Money can leave anywhere. It can. Money can go anywhere it wants to go. And if you decide to go into these punishing tax rates, money will leave. At the margin, money will leave. If you have, for example, in Canada, I have a 53% tax rate. Push that any higher, I'm right against the border right now. When I say I'm against the border, I mean both geographically and psychologically. I'm right against the border. I have an American PhD. I have significant wealth. With my American PhD, I'm front of the line for a green card. Push me a little bit more. Call me a dirty name one more time because I'm successful. And I'll leave. I don't need to stay here, and you will lose my tax base. You can't afford to lose too many of me, or too many like me. So, 53%, fine. I'll pay my 53%. It's actually higher than that because we have a 13% consumption tax. So of the 47 cents I get left over from every dollar, I can only actually buy 40 cents worth of product with it because there's 7 cents that's going to be sales tax. So I'm actually at 60% on consumption, if you think about it that way. And I pay it. The top 10% of income earners in the US and in Canada pay 43% of all tax. So when we talk about fair share, they pay their fair share, 4.3 times their fair share. So their fair share should be their tax rate. Their fair share, for Sanders and Warren, fair share means significantly higher tax rates, and they think that that's fair. Let's take 90% of everything you make, and that's fair, because there are other people who can't. Well, listen, there are lots of people out there with gold medals from the Olympics. I got none. How's that fair? Right? You can use the same argument for almost anything. So I think that would be a mistake, is introducing new taxes or higher taxes. If you want to normalize, if you want to say, look, if there's a tax and some people aren't paying that tax and some people are, that needs to be fixed. I'm all on board with that. But as far as not paying fair share, I've done my round of the big accounting firms, and I've shown them my tax return saying, here's how much tax I'm paying. What do you know that I don't know so that I don't have to pay that? And to a person, it was, well, there's nothing you can really do about that. We can follow different strategies about how you make your money, but once it's made, that's the tax rate. That was it. So find me one of these people who are not paying their tax rate because they're in the wrong line of business. They could open up a fantastic business consulting other people about how they get away with not paying 53% tax. Find me one of these people. They don't exist. It is just something people like this, Sanders and Warren, say to get votes. But it's just simply not true. Anyways, I'm ranting on that. I can't help it. Every time I hear somebody say they just need to pay their fair share, I know how much I pay. And it just kills me because I can't find a single person who doesn't pay their fair share. I can't come across one of these successful people who suddenly are paying only 15% tax. I simply can't find them. They don't exist. They're unicorns. They're just something that these people say because they believe that other people are stupid enough to believe it. Good outcomes. What is good? Any and all spending, the government spending, the more the better. Don't stop at 2 trillion, spend 8 trillion, spend 20 trillion. The more the better. I'll explain that in a second. Wage inflation is a good outcome as well because it will increase the multiplier because most people will spend every single penny they make. Even if you give them more, they'll spend even more. They gotta have stuff. So that'll increase the multiplier, which will increase GDP. Now, why do I say any and all spending, the more the better? Imagine that you own a restaurant in a tourist area. And over the years, you've noticed a change in how your customers have been paying. 5 years ago, everybody was paying with cash. 3 years ago, everyone was paying with debit cards. Now everyone's paying with credit cards. And you've noticed another peculiar thing as well, that when they had to pay with cash, the average bill was per person was $25. When they paid with debit card, the average bill per person was $30. But now that they're paying with credit cards, the average bill per person is $35. They're actually spending more when they don't have to spend cash, if they don't actually have to touch it. And if it's not theirs yet. So with credit cards, they're spending even more. Now, you know this is unsustainable. Everybody's loading up on their credit card. It's unsustainable. Do you stop in the middle of a busy lunch and say, people, please, watch what you're doing here. This is unsustainable debt. No, what do you care? What do you care? You own the restaurant. Your customers want to load up with a whole bunch of credit debt. Let them. Your job is to make money that day. And that is us as investors. We don't really care what the level of debt is. We only care how much more spending is going to happen and for how long it continue on, because we'll get it in the end. You have a central bank and you have a government. And whenever there's a recession, the central bank does stuff. Investor sits right here. The investor class gets paid first, and then it trickles into the economy. When a government spends money, the consumer gets it. Once the consumer gets it, they go and spend it, and it ends up with the investor class. No matter which way you go, the investor class gets everything in the end anyways. So if the government wants to spend more money, let them spend more money. They'll spend it. It'll just travel through consumers, through either outright payments to consumers or through job programs like infrastructure. In the end, we are going to get it anyway. So more debt. All right, let's think about where the S&P could be by the end of the year. Okay, end of year target on the S&P 500. 45.95, call it 4,600, which isn't that much higher than where we are now. Only about 300 points, 250, 300 points higher than where we are now. Last I looked a few minutes ago, we were at 43.17 on the S&P. The numbers that I use here for earnings on the S&P, these are consensus earnings. There's a lot of smart people out there doing a lot of good work, and this is what they do all day long. And the consensus is you take all of these smart people's forecasts and you just take the average. diving into them as a retail investor, diving into it and creating your own forecast is not going to be as rigorous as the ones that are already done. Rely on experts wherever you can. Rely on experts, but not just one, but a whole bunch of them. So the consensus forecast is usually a very good number that for the time and effort you put in, you're not going to get better than this. 191.37 for 2021, 213.76 for 2022. And if we're coming up with a year-end price target, it's forward earnings that matter, not historical earnings. So it's a forward PE that you're calculating, so you want 2022 earnings. The question becomes, well, what multiple will you apply to it? At 191.37, where the index is right now, is 22.5 times earnings. The consensus multiple is 21.4, which is somewhere in here. I've taken this earnings number and I multiplied it by 4 different multiples, 20, 21, 22, and 23. And I get different weightings. Being that 21.4 is midway between 21 and 22, I weight them each 30, and I weight the two extremes, going down to 20 or up to 23 by 20%. And it's just a weighted average to get to 45.95, which is a target considering consensus. If everything comes in as consensus, I think you drift to 45.95. What would force us lower down to 42.75, let's say by year end, is earnings that come in lower than the consensus earnings forecast. So every earnings season, there is an analyst forecast, a consensus forecast of what companies in the index are going to report for earnings. If those earnings come in lower than the consensus, not lower than last year, they can still beat last year. They can still have great numbers, but if they're lower than the consensus, then they'll be lower than these particular numbers that were the consensus forecast numbers. So if you have, on average, one or two companies can come in lower, but on average, as you start adding up all the companies, the number to look at is earnings in relation to consensus. Q1, I think, came in 23% above consensus. But the earnings forecast for Q2 is something like 60 to 65% higher than the same quarter last year, because last year was a terrible comp. Everything was shut down. So we're sick. We have to beat it. The numbers have to beat it by about 65%. Beating it by 65 is just consensus. So you have to beat it by even more. So it's looking at the earnings as they're being reported, not year over year, not saying, oh, we're up 50%, we're up 60%. By the way, if we're only up 50%, we're below consensus. It is in relation to consensus that's going to matter. Because if we're coming in above consensus, then these two numbers here would have to go higher. A steepening yield curve. Right now, the 10-year is below 1.5. I've seen some forecasts for end-of-year 10-year rate at 2%. That would be a threat if you have a steepening yield curve, because company interest, the interest cost for companies would begin to rise. Not only that, you would then start to have competition at the margin. You would have competition against treasuries for long-term investors. 2022 corporate tax rates coming in greater than 28%. The market seems to be comfortable pricing in a move from 21 to 28, with Biden saying, look, we gotta do something here. 21 is too low. Maybe 35 is too high, so meet me in the middle at 28. Anything above 28, that's going to be a problem, because a greater part of the share would then go to the government, and you'd have less for investors. And extreme COVID variants. And these would be a new variant, perhaps. So what are we at? D, Delta, Epsilon. An Epsilon variant that is resistant to the vaccines. And then we're right back to stage 0 all over again. That's why it's important to vaccinate as fast as we possibly can, so that you reduce the amount of variants that could show up, because of the virus is always mutating. Well, if you can stop the transmission from one person to the next, well, then you can stop these variants, right? So the speed of vaccination at this point is the most important thing. So that's something to look at. It's nothing in the rearview mirror. You can't say, well, let's just ignore it. We still have to watch the speed of vaccines. How fast are they getting out there? How fast are they being deployed? How fast are they getting into arms? That's going to matter. because you get another variant that shows up. It could be resistant to the vaccines, and suddenly, again, you're at square one all over. What would push us higher from the 21.4? Where could we end up being? Earnings that come in more than 20% higher than consensus. First quarter was 23% higher, and you saw end-of-year forecasts increase in line with that. Well, if you have consensus earnings coming in greater than 20%, you're going to see another jump in end-of-year the end-of-year forecast, so that the end of year you could be somewhere around 4,700 to 4,900. A lower 10-year yield, so that we're under 1.5 right now. So instead of the yield curve steepening, we get even more flattening of the yield curve. You get a 10-year under 1.3% and lower. That's not going to offer a lot of return to long-term investors. You'll squeeze more of them out into the equity market to take on more risk. So a flattening yield curve at this point, 10-year yield pushing under 1.3, I think that would be good for equities. 2022 corporate tax rate coming in less than 25%. Biden saying meet me in the middle at 28. Maybe he can't get 28. Maybe he trades off 28 for 25 or 24 to get something else. But anything under 25%, that means this already has a consensus of 28% in there. You get anything under 28, this number is just going to go higher. And vaccines greater than the variants, meaning that even if another variant shows up, the vaccines are just as successful with those. I think Moderna says, look, our vaccine is just as successful with the Delta variant as any others. So it's not really an issue. The only issue is it transmits faster, but it doesn't reduce the efficacy of our vaccine. So as long as that stays in play, then we don't have to worry about that. So what are we looking at? We got to watch inflation. We have to watch inflation. That is the Super Bowl of economic data right now. That's the big game on the street. And July is an earnings month. So what we're going to pay attention to is where are earnings coming in versus consensus. The greater they're coming in versus consensus, the more you can push towards the upper end of the range, 47 to 49. If they're coming in lower, you're pushing down to the lower range. If they're coming in as consensus, it's all about investor sentiment. Are they going to be okay? Is the market going to be okay with consensus? Or do we have to beat consensus just to stay on what we think is a consensus year end? I don't know. And then watch that yield curve. That's important. So, it comes down to a few things that we're looking at. Inflation, earnings in relation to consensus, the shape of the yield curve, and what's going to happen with the corporate tax rate and COVID. 5 things to put on your watch list. Scan the news every day for that stuff, and that will tell you which way to lean. Whether you're leaning more towards heading back down to 4,000 by year end, or whether you're leaning more towards maybe, dare I say it, pushing up towards 5,000 by year end. Anyways, that's it.